Hi, everyone. Welcome to another episode of Tax Talk Unfiltered. I'm Spencer Carroll, your host, and I'm joined once again by Julie Suskin, Gelt's head of tax, and Tal Binder, CEO and founder of Gelt. Great to have Julie back on another episode after she joined me with Shoshana. And today we've got a fun topic, a very important topic for business owners, and timely topic depending on the state that you live in. We want to talk about PTET, which stands for pass-through entity tax, and it's a pretty powerful strategy and credit for business owners, specifically if you have an S corp or a partnership. And for the right individual, it could mean saving tens of thousands of dollars on your income tax. So you definitely do not want to miss out. So Tal and Julie are going to walk us through some of the ins and outs. We'll start with just what it is. What does this PTET stand for, and why does it matter? And I'll kick it to Tal first. If you're talking to someone, Tal, who has no idea what PTET even means or stands for, how do you usually explain it to them in layman terms so that they can understand why they should pursue it?
So in 2017, Trump passed his first tax reform. And as part of that tax reform, he introduced a cap to state and local income taxes on the federal one. So if you're an individual taxpayer and you're filing your taxes, you have two options: either use the standard deduction, or using the itemized deduction. Usually you'll make the choice based on whichever is higher, but that's the choices for individuals. As part of the itemized deductions, one of the things that you could have deducted is the state taxes. So if you live in New York or in California or in any state that has income tax and you're making quite a lot of money, you would basically write off the state income tax from your federal taxes under the itemized deduction. It all changed in 2017 when the Tax Cuts and Jobs Act reform was passed. They capped basically the state and local taxes and on the itemized deductions at $10,000, and that screwed up a lot of people. And of course, there is the question of why to do it. Some would say that it's in order to put a finger in the eye for all the blue states after Trump won, but that's a speculation. But that's basically what happened. In response to that, it pissed off a lot of high income tax states like California, New York, and others, and they started to create legislations to create a bypass for that limit. And that's what PTET is. It's basically a way for states to allow specific types of entities and businesses to deduct state tax from the federal taxes without the $10,000 limitation. Each state created their own laws, their own policies, so it's just like different between states. Not all states pass that, for example. So there are some states that don't have it at all, even though they have income tax in that state. But the way that it's generally working, it's usually eligible only for pass-through entities because it's a PTET, pass-through entity tax. So it's S corporations or partnerships. And what happens in those cases, you basically pay the personal state taxes on the entity level, meaning the partnership or the S corporation is paying it throughout the year or at the end of the year. And you as the owner, the owners of the partnership or S corporation, they're getting basically tax credits against their personal income tax with the state. So it allows you basically to deduct state taxes from federal taxes without the $10,000 limitation, and it was created as a bypass to the Tax Cuts and Jobs Act reform in 2017. That's what PTET is, and of course, if you start calculating the numbers, it can add up to quite a large amount of money and savings for certain businesses.
So it helps you bypass the $10,000 SALT cap. Let's say you're a business owner, but you've still historically taken the standard deduction personally. Is PTET still something you want to pursue, even if in your past you haven't itemized?
Julie, you want to take it? I'll take it.
Sure, I can take it. No, it's a really great question. Again, as we mentioned, we're at this $10,000 cap. However, if you are a high net worth individual, your business is earning a lot of money, chances are you're going to be paying more than $10,000 of tax a year. And again, that $10,000, keep in mind, it's accumulation of property taxes, sales taxes, income taxes. So you are being stuffed into such a small box in terms of how much you can actually benefit from the deduction. So even if you are taking the standard deduction, right? Your CPA has determined that the itemized deductions, it's not beneficial for you. You don't have enough to make it worth it for you. That's a totally separate conversation as opposed to whether or not PTET is relevant for you, because you could be paying $50,000 in individual state taxes, and you would still be able to take that deduction regardless of whether or not you itemized, right? You'd be able to take it, as Tal said, as a business expense through your business, be able to take a dollar for dollar deduction for your state taxes, and then get a credit for those taxes on your individual return, and you've totally bypassed the $10,000. So really, the itemized discussion is kind of a whole separate area that really doesn't interact a whole lot with the PTT. And we see a ton of clients where PTT is highly, highly relevant for them, regardless of how they treat standard or itemized deductions on their 1040.
Got it. Yeah, and the different states and how they treat PTT does make it tricky. I was talking to a client of ours, and he lives in Pennsylvania, and we were talking about some different strategies that he could pursue working with Gelt, and very successful business owner, makes over $1 million a year through his business. And I brought up PTET thinking, oh, it's going to be great for you. Pennsylvania, I don't think they have a super high tax rate, but at his earning, probably still paying, to your point, Julie, $30,000 to $50,000 in state income tax, only to then look it up after the call. Pennsylvania is one of those states that offer PTET.
They don't.
Yeah, so it depends on where you live, whether they'll even let you do it.
Totally.
But something that makes this episode very timely is we want to spend a little bit of time talking specifically about California.
Yes.
Because California has some strict rules that you do not want to miss out on. And so, Julie, I'll kick it back to you.
Sure.
What makes, for the listeners, the California PTET especially tricky to navigate?
Sure. No, that's a great question. So as Tal had mentioned before, every state decided to come up with their own regulations around PTT, what the tax rate is, when the due dates are, what the estimate requirements are. Every state has their own regulations. California decided to be a little bit different even from the rest of the clan. Most of the states kind of landed on a sort of a familiar pattern of when you need to pay PTT, and California decided to kind of come up with their own process of how to pay PTT. And the way that California works is that you need to pay in order to opt in. There's this concept of opting into PTT. It's something that for a lot of states you have to elect. You have to tell the state, hey, I'm interested in paying in PTT. For some states, they're more flexible and you don't necessarily have to go through this formal process. But California is one of those states where they require you to actually make a statement and say, I am opting into PTT. And the way that that's done is that the first payment needs to be made by June 15th in the middle of the calendar year that we're opting in for. So to illustrate that, today is May 14th. By June 15th this year, so just around a month from now, taxpayers who are interested in opting into PTT within the state of California would be required to make 1/2 of their PTET payment by June 15th. Now, not to go into details of how that payment is calculated, there's all sorts of intricacies, but basically to generalize it, there is a certain calculation, a certain payment that would need to be made by June 15th. It's based on the 2024 financial statements, right? So we're in the middle of 2025. There's a payment that would need to be made by June 15th based on 2024. It's at a flat tax rate. And by making that payment, you are essentially opting in. And you're telling California, for 2025, I am choosing to make an an election towards PTET so that I can benefit from this strategy. And then the second payment would need to be made by March 15th of the following year. So by March 15th of 2026, you would be making the second payment towards California's PTT. So again, California is on this little bit of a different schedule than most of the other states, which is what makes it a little bit trickier to navigate. They also have a very strict deadline. So if you make that payment June 16th, 2025, unfortunately, you are ineligible for opting in for the 2025 calendar year, and you'd have to wait until the following year to opt in. They are very inflexible. There's unfortunately really no way around it. So we are laser focused right now on making sure that all of our clients who are eligible for PTT, that they don't miss out on this opportunity, because it literally comes around once a year.
Yeah, for sure. California's strict. They're not going to give you any.
No, they don't have mercy.
Yeah,
That's the price of living in great weather. There is one thing to add. If it's your first year electing for PTT, you can they have some kind of like a minimum payments. If it's your first year of business, you know that you want to opt in, or it's the first year that you want to elect the PTT. The minimum payments the payment that you need to make by June 15th, it's either half of last year PTT payment. If there is nothing there, it's at least $1,000. So that's kind of like why it's at $1,000. Who knows? That's what they decided. But that's something definitely to take into account.
Yeah.
And
Totally. We were talking the other day about PTT, specifically in California too, and you were saying that you have to make the payment in the calendar year if you want it to count for that tax year. So you were saying, and you'll be able to explain it better than me, but if you're having a particularly good year, let's say in 2025, for example, you make your June 15th payment to opt in, elect that you're going to do PTT. You might even want to make your second payment in Q4 instead of waiting until March 15th. Is that right?
yes, so the way individual taxpayers work, they report taxes based on cash basis, kind of. Whatever they receive cash throughout the year, that's what they will need to report. Meaning that also as a business, and fix me if I'm wrong, Julie, of course, if they want, most of the businesses, if they're, let's say, on cash basis, and they want to include the PTT in the current tax year, let's say that you have a very big 2025 year, and you want to make sure that you include, like you squeeze PTT really hard and get the most out of that. And you don't know what will happen next year. If you're paying, let's say, $50,000 PTT and payments on June 15th, and then you're making another $50,000 on March 15th of the following year, you will be able to take only the $50,000 that were made during the current tax year.
Mm-hmm.
So if you know that it's a big year, you need to make the second payment during the tax year that basically you want to take the credits for. And that's something that definitely we see a lot of professionals miss a little bit. And so you need to really, if you're living in California or in any other state, when you're making those payments, you need to be very cautious for 3 dates, not 1 date. Date number 1 is really the initial, just to enroll into the PTT, making sure that you are eligible for that. Date number 2 is during Q4, when your financials are a bit more set and you know where you are a business and where is your income. Then start to maybe consider making another payment during the tax year. It's not mandatory. It's just like a pure strategy that you can choose to enroll into. And then a third payment, or potentially second payment, depending if you did another one, is at whatever state decided is the final deadline. So which California, let's say March 15th in this case.
Yeah, and I just want to actually illustrate all of this just with actual numbers, just to kind of give everyone an idea of, what we're kind of throwing around dates and numbers of what this actually practically looks like. So just using Tal's example, let's say we have a taxpayer, let's say his business is generating $800,000 of profit, right? And he makes one payment June 15th of the current year, so June 15th, 2025, of $50,000. Makes a second payment before the year end, right? Within the calendar year, a second payment of $50,000. So we're talking about 2 separate payments of $50,000 for a total of $100,000 of state tax payments. That means that when it comes to the 2025 tax year, this client, this business that had profits at the end of the year of $800,000 will then be able to take an additional $100,000 deduction of state taxes. So instead of being taxed on the original $800,000, you are now being taxed on $700,000 because you are getting a dollar for dollar deduction on the state taxes that you paid. That, again, to clarify, is only if you made that second payment within the 2025 year. If you paid it in 2026, no problem. You could get the $50,000 second deduction in 2026. But just to illustrate it with numbers, we're talking about an available additional $100,000 deduction that is not available if you just pay those taxes regularly through your 1040. They have to be paid through this PTET process, specifically through your business and not as an individual, which you may have paid beforehand. So just wanted to illustrate that with, a practical take-home example. That we're talking some really big tax savings.
I would even take it one step further. We have a client that we were talking to him. They are not sure if they will. They are making a lot of money. They are making about $2 million a year of profit. By the way, that's their profit, and they right now they're structured in one way, and they're thinking about making the transition, maybe to become an S corp, maybe to change into a partnership actually, and then take into account take advantage of the PTET in California. But they are not sure yet because there are a lot of variables depending on clients, depending on a lot of variables for them. There is a chance that it would make more sense to them to set up the partnership, paying the $1,000 as PTET advancement. If it works out well, they lost, let's say, the cost of the compliance of the partnership plus the $1,000. Let's say that's the worst case scenario, but at least they leave the door open to make sure that if something changes,
Totally.
they still have it in place. So that's
Right.
another way to really walk around the system and around what was created. There is one more thing that I want to add, and I know that it's not in the agenda for today, but a couple of days ago, 2 days ago, the Republicans published what they call the Big Beautiful Bill. There is a more formal name, I'm sure, for the bill. I'm just using Trump's terminology, or AKA BBB. One of the provisions there is about standard deductions and PTET. They are considering there are multiple ways to phase that, but one of the considerations in what we are seeing in multiple proposals by Republicans for the upcoming tax reform is increasing the standard deduction to $30,000, which will change if and how it makes sense to use PTET. But as Julie said, PTET, the standard, the sole deduction, the cap is not just about the state income tax from your work or from your business. It's about your property tax. If I'm paying more than $10,000 for my property tax, for example, and that would be nice to take more than $10,000 on the itemized deduction. But in general, it might change a little bit the rules of the game if it's being passed. Of course, it's not relevant for 2025, but it's definitely something that we are keeping our eye open for 2026. So it's very exciting time for taxes.
So, Tal, real quickly, because I do want to get back to our agenda, but you're saying the standard deduction for a single filer goes up to 30,000?
Oh, I don't remember if it's for the single filer or it's for the merit filing jointly going together, and the cap for $30,000. It might be for both, by the way, if they didn't differentiate that. But they're looking at changing certain things under the itemized deductions. And when they touch something in the itemized deduction, it might affect also the business owner's PTET choices and what they do. But
Okay.
well, probably we will do a full episode just about the BBB,
Yeah.
which I think it's really interesting what they're
And
doing.
and
Lot
just
of cool
to
stuff
put
going
a
on.
bow on Julie's example, which was great, going back to how we first described what PTET is, without PTET, you get the $10,000 cap. That's the max that you could deduct on your federal return. multiply that by your federal tax rate for a high earner, probably somewhere in the 30 to 40%. That's a
Yep.
$3,000 to $4,000 tax savings, and that's it. You're capped at the 10K. But with
And
Julie's,
that's in that, just to clarify, again, you're saying you're excluding property taxes, right? So it could be your property taxes are eating up 8 out of the $10,000. So then you're only getting an additional $1,000 deduction. So you're giving a very liberal example, but in most cases it's not even $3,000 to $4,000. That's being very generous. Yeah, pretty significant.
it does get tricky though. I want to talk a little bit about our business owners out there that either do business in multiple states, so they're filing income tax returns in multiple states, or maybe they're in a group or a partnership, and so they've got S corp owners or partnership owners in different states. I'll open this up to Tal, because Tal and I talked about it a couple days ago. What are some of the curveballs that people have to look out for if they've got PTET in multiple states for their entity?
Yeah. And by the way, I just want to mention that we need to find a better way to describe PTET because it doesn't roll off the tongue that easily. So we need to find like a better name. Maybe the blue tack. But because it's mostly in blue states, but not only. So basically what happens, let's say that you have a partnership and the partnership is based in California, but you have a partner in California, you have a partner in Georgia, and you have a partner in Florida, let's say. Taxes, all those partners will need to report taxes in all 3 states because the partnership is basically operating in each one of those 3 states. And then you're getting into the decision, should you enroll into PTET? So when you enroll into PTET, you do it at the business level, basically. It means that all the partners, even if they don't live in California, and let's say that there are $400,000 of profit from that partnership, whether you want it or not, like the whole business is enrolled into PTET, meaning that you will need to pay the whole amount from the $400,000. Even so, some of the profits from that business is not necessarily allocated only to the owner that is living in California. The other owners, because they have a business in California, will need to report taxes in California anyways, and it can basically be taken against their taxes. However, PTET rate that you need to pay is at flat fee. And if I remember correctly, for California specifically, and again, that's an example. I give California as an example, but it's relevant to all states. And the same problems, different problems, but they're similar in all different states. If I remember correctly, in California, the PTET number is about 11% or 11.3%. Fix me if I'm wrong, but like there is a big chance that maybe one of the owners, it will be beneficial for him because he's paying that state income tax rate. But the other owners might not get quite to that threshold. And traditionally, they would have been paying less than the 11.3%. So in that case, like definitely speak to your tax professional to make sure that basically the payment makes sense as a business. If there are any workaround around that, that's a big topic. We don't have to get to that in that conversation, of course, but there are certain workarounds in those specific cases that can be deployed, but definitely it's something that you want to take into account as business owners with multiple partners, especially if certain partners are living in a lower income tax state and not necessarily in California or New York or other places. It's definitely like a big consideration. So the moment that you have more than one partner, the moment that some of the partners are not living in California, that's the moment that you want really to have a bit more hands-on planning around how much you should pay, whether you should pay it and enroll into that. What are the cons and what are the pros when you're doing it? And what are the tax consequences for the other partner who don't live in California? But it's definitely a complication that we are seeing quite a lot, and be careful for that.
Yeah. Well, and I'm sure we don't have to get into it today, like you mentioned, Tal, but I'm sure one of the workarounds that we can help clients with when you have partners in different states is the structure of your entity and the flow of funds and income in the proper way to different entities to help with that complication. And that
Yes,
is something that we help clients with at Gelt.
yes. There are multiple workarounds, but it really depends on what is the business doing, how much money is involved, who are the partners, because like when you create complication in taxes, it usually costs more money and there is maintenance fee for all of that. So when you create a complication, you want to make sure that the tax upside of that complication, um, basically it's better than the downside of the cost of
Yeah.
maintaining the entity structure or whatever you're trying to create. It's definitely something that we're doing for our strategy clients, and it's a really cool subject that we enjoy doing.
Yeah. Julie, any missteps that we want to warn people to look out for when they're planning for PTET and working with their CPA? Hopefully it's Gelt, but whether it's us or someone else.
Sure. So, like we said, there are some states, I would say probably namely California and New York, which are probably the trickiest to navigate because of their very interesting deadlines and not so intuitive deadlines. New York's deadline happens to even be trickier because it's earlier on in the year for the following year. So I think one of the biggest misses for a lot of clients is that you need to have a lot of foresight and to really you're basically making a very large decision. You're laying out a lot of money well before you're going to see it applied on your tax return with the understanding that your business has a certain growth trajectory. You're going to be paying taxes on this eventually. You almost need to feel confident in knowing that this is where you're going and this is the right step for you. Especially when it comes to states that force you to go to be in that position, right? So for California, we're saying by June 15th, you need to make a decision on what your 2025 business is going to look like. We're just in the middle of the year. We're not even halfway done yet. We're not even in July. So it really requires a lot of foresight, and almost a lot of, just confidence in your trajectory of your business, your planning of your business to be able to say, this is a good choice for our business. It's again, you kind of only really see the puzzle pieces fall into place a little bit later, sometimes even almost a year later. But really, it's so important to have those conversations before you're in a position where you're a day late and then you're a whole year late and then you miss out on the entire year. So, that's that planning piece. And now again, some states, as we mentioned, are not as strict and you can kind of catch up more so on the last minute. There are other potential negative implications by doing that, but a lot of states won't tell you no. California and New York will. So those two particular states, really, you have to feel comfortable being a little bit uncomfortable making such a large business move, so far in advance of really having actual, finalized numbers. But again, it's based on just a good planning and making sure that you have a CPA to really guide you, and direct you as to whether or not this is a good choice.
Yeah. I would imagine it's a pretty tough cash flow decision for
Totally.
especially early stage businesses in California and New York,
Yep.
where you think to yourself, okay, I can make this early PTT payment and hopefully save X on my taxes, or I could invest this money now in new technology, inventory, staffing, something like that you think might scale your business
Totally.
fast in this
Yeah.
year.
It's a trade-off, right? It's a trade-off where businesses have to make these decisions of, I have X amount of cash flow available. Now, again, keep in mind that if you don't opt into PTT, you're still paying that state tax, right? For a California partner who is an owner of an S corporation, they're paying tax to California whether they like it or not. It's just a matter of when you're paying it and how you're paying it. So you're either paying it a little bit prematurely through the entity and then benefiting from this deduction, Or if you say, you know what, I don't have I don't have the bandwidth right now to pay that tax, you're paying it 8 months later on your individual return. So it's not like you're going to be able to see this, other potential opportunity for that cash. That cash is ultimately going to the state of California. So the argument for PTT is let's get the most out of it. Or let's get the biggest bang for our buck. You're paying this anyways. Let's maximize it. So but it's definitely
And
a trade-off.
and of course, if you need to pay the money, but then you need the money for other reason. Let's say you need let's say that you're making a payment of $100,000 for PTT, but now you have a cash flow problem because you need to pay employees, to purchase, like to buy, to invest in marketing. Get a short-term business loan. The interest on that loan, since it's for business purposes, will be deductible for the business. So basically in California, let's say you're getting back 37% or 37 cents on the dollar, assuming you're at the top tax rate, for each dollar that you're paying, like that you're doing on PTT. And then if you're getting a short-term loan, let's say for like a couple of months and you're paying for that 7-8% annualized. So for a couple of months, it's 2-3%. Those 2-3% will be deductible if it's for business purposes. If the goal of this money is to do marketing, to invest in the business, pay bills for the business, it will be deductible. So the 2-something% loan, the percent interest is deductible for you, which is another 37 cents on the dollar or on the interest. So there are ways around that, even if you don't have the cash flow. It's still, if you're eligible for that, highly recommended. And of course, consult your tax professionals or us about
Well, and this has been a perfect conversation for the question that I get quite often from interested clients who haven't yet signed up for Gelt is, what makes Gelt different? Why should I care about what you guys are doing? And I think PTET is a great example because it's one thing to just make your PTET payments, at least in California, right? Where it's a little bit trickier. Yeah, you could make them June 15th and March 15th. But like we've already talked about, well, what if you're having an especially good 2025 and you think it's going to go back to normal and drop a little bit in 2026? Well, maybe you should make that PTET payment early in Q4 so you can get credit for it in the 2025 tax year. Is your other CPA or tax firm that, yes, is telling you to make these payments, are they having that sort of nuanced conversation? Or what if there's a cash flow reason that you want the money? Is your CPA firm or tax firm talking about taking out a business loan and the deductibility of the interest expense? Maybe, maybe not. That's what makes us different, is these strategies are not always so black and white, but there are still some nuance to it. Yeah, there's gray.
Never black. We never cross the line, of course. Just for the record.
Yes.
But yeah, I think that's a great point. I think that Julie and I spoke over the phone yesterday, and definitely you brought it up as well. That from when Julie joined Gelt, definitely it was a new, I would say refreshing, but I'm not sure if she would say refreshing, just view on taxes. Because in traditional tax firms, the strong tax firms out there, which is the medium to large size firms, they tend to be hyper focused on quality of compliance, which is important by itself, but they're really missing the more creative edge, the more like edgy side, for sure. Or I think that I had a client that described it more on the right brainer, something like that. He said that the right side of the brain is more responsible for the creative side. The left side of the brain is more responsible for the logical side. And I think that we are doing our best to combine both of those approaches the best we can in a structured way at Gelt. And that's one of the ways that we are very different. Besides the technology and what the other things that distinguish us, if that's the right word, I'm not sure if that's the right word. But anyway, I think we had enough and I have to go, actually.
All right, we'll wrap it up then. Tal, Julie, thanks for joining. Thanks for listening, everyone. Once again, subscribe to the channel, the newsletter, send us topics that you want us to talk about, and we look forward to seeing you on another episode of Tax
Differentiate.
Talk.
The word is differentiate, I think.
Differentiate.
It would differentiate us.
Yeah, we will to do that.
Thank you, Spencer,
thanks,
so
everyone.
much.
Master of the English language. Bye, guys.